Hi, everyone. Welcome back. Hope you had a great lunch break, and we're ready for our next presenter. Derek Singh, the SVP in Quant Modeling Treasury at U.S. Bank, is a quantitative executive with 20-plus years industry experience, working for top investment banks, commercial banks, and hedge funds in derivatives valuation, ALM balance sheet modeling and risk management, and PPNR economic modeling and stress testing. Derek's academic research is focused on robust optimization problems and applications of machine learning in finance. Please welcome Derek Singh.
So, can you guys hear me? Okay, great. Well, thanks for that introduction. As the host said, my name is Derek Singh. I lead quantitative modeling for the Treasury Department at U.S. Bank. For those of you that do or don't know U.S. Bank, it's about 500 billion AUM in balance sheet size, about number 5 in terms of size in the U.S. and balance sheet among commercial banks, primarily based in the Midwest, although we do have some exposure on both coasts. And what I'd like to talk to you about today is some of my academic research in reinforcement learning. This particular project is focused on algorithmic trading. We're not quite there yet in terms of production model use for reinforcement learning at U.S. Bank, but I would like to see us, and it's my hope that we explore some of these more sophisticated machine learning techniques next year. There's a number of ways we could use this algorithm and then this type of technology for managing our balance sheet, funding positions, risk management, investment allocation decisions, and things like that. Okay, so the agenda, there's a few topics I'd like to cover. I will say that there's quite a bit of mathematical detail in these slides. The intention is not so much to lose the audience, but for those of you that are interested in understanding some of these terms and these concepts and exploring these algorithms in detail, I thought it would be useful to give you some pointers and at least give you an introduction to the math and the language and the machinery that's involved here. And I think, at least for me, repetition helps. And so it's my hope that as you go through this, perhaps a few more times, it'll start to sink in a little bit better. So the first thing we're going to talk about is just a very brief primer on reinforcement learning. I mean, this is a subject within itself, and there are courses in graduate school and machine learning departments that are taught just on this topic. So it's a very deep topic. I'm really covering just skimming the surface of it, if you will, just to introduce the concepts and motivate the problem that I'm researching in this particular project. The next thing we'll talk about is some algorithms for so-called model-free policy search. For those of you that aren't familiar, the notion model-free, when it's not model-free and essentially you have a model for the system dynamics, one way to solve these kind of problems, or the typical way to solve these kind of problems, is dynamic programming, or DP. For an MDP, or for a Markov decision process, that's the standard technique, but DP suffers from what's called the curse of dimensionality. So it becomes progressively harder as the dimensionality of the problem gets higher. And one of the advantages of these kinds of techniques, hence the name model-free, is that you don't require a very detailed specification of the system dynamics. Often in real-world problems, you simply don't have that. And so that's one of the appeals of these techniques, model-free. But given that it is model-free, it comes at a cost also, because now you need to learn the system behavior as well as solve the optimization problem that you're trying to solve. So it typically requires a lot of data to both learn, quote, system dynamics and then solve your optimization problem. So some of the techniques we're going to cover, these are some standard ones: gradient ascent, expectation maximization, policy prior search. The focus of this project is really to compare these gradient techniques, the three I just mentioned, with so-called gradient-free techniques. Evolution strategies is one category of gradient-free techniques. The appeal there is that when you're solving a problem where the solution landscape is very jagged, ill-conditioned, or not easily differentiable, you don't need to take the gradients, essentially. You use these evolution strategies, which is a different philosophy. The fundamental principles are based on the ideas that if you ascribe to natural evolution are why we're here today, right? You know, survival of the fittest, reproduction, mutation, natural selection, things like that. And so those concepts have been encoded into a class of algorithms, and that, given the name evolution strategies, we're going to talk about, or at least this project explores two of the sort of leading edge or cutting edge evolution strategy techniques. One is called FEM, finite expectation maximization. The other is CMA, covariance matrix adaptation. So what this project is about is essentially comparing these gradient versus gradient-free techniques on a particular problem. This is a stylized problem, an algorithmic trading problem where the market is set up in such a way that it's exploitable. It's not real market dynamics. That would, of course, be interesting to explore too. But this particular problem is stylized and used in the academic literature to see, because there are certain properties to the market dynamics, such as autoregressive behavior, these algorithms can learn to exploit those and produce pretty sizable profit. And so the question that's posed in this project really is, how do these evolution strategies compare versus these gradient policy search techniques in terms of performance out of sample? Okay, so this is just one slide on reinforcement learning. It's a little bit compact, and like I said, there's a whole lot more to this than just this one slide. This really just scratches the surface. But as I mentioned before, the machinery, we consider an MDP, a Markov decision process, discrete time, where an agent observes a state, an ST, and takes an action, and then transitions to a new state, ST plus 1. And so it's the system environment or the system behavior that I talked about that does that transition for you. And in these model-free algorithms, you don't necessarily know what that behavior is. And then once you take an action in a particular state, you receive a reward, and you continue. The idea of reinforcement learning is to try to learn an optimal policy. We use pi here typically to denote the policy, star meaning optimal, that maximizes expected return. So take expectation under this transition measure, p, which is determined by your policy pi, of R of h. R of h is essentially the cumulative return over the time horizon at which you're conducting your experiment. So it could be infinite, but in this case, it's finite. And we usually employ some type of discounting, and we just sum up the cumulative rewards, and we try to maximize that. Of course, there are other types of functionals you could use to maximize, not just expected return. You could think of some kind of risk-adjusted functional that includes CVAR or something like that. But at least for this particular problem, we're just looking at expected return. So we define a stochastic policy as a conditional PDF. Again, pi of taking some action A, given you're in some state S. It's a valid distribution, so it should integrate to 1 if you sum up over the actions in the action space. It can be discrete or it could be continuous, depending on the problem. And so this transition probability pi, according to some policy h, is well, what this equation says. You take a probability of being in the original state times the transition probability of being moving to the next state, given that you take an action, and the policy pi is what determines the actions that you take in particular states. We refer to that whole sequence of states and actions as a trajectory h. And like I said, in this case, it's a finite horizon capital T. So it's just that sequence, ST, AT, from t equals 1 to capital T. And there's, of course, a terminal state at which you end. And so we define the cumulative return, as I said before, as just your present value of those cumulative rewards over all those states T from 1 to capital T. So for those of you that are familiar with DP or dynamic programming, There are these concepts called value iteration and policy iteration. And one way of thinking of reinforcement learning is perhaps a richer or more expansive way of thinking of value iteration and policy iteration. There's other ways of characterizing it, but that's how I tend to think of it. And so this talk is primarily focused on policy iteration and policy search. The idea, one of the fundamental quantities that you'll see or come across in reinforcement learning is called the Q function. The Q function is what's called the state action value function, and it's defined in this way here. It's the expectation of the cumulative return given that you're starting in some particular state and you take an action. Now, there is something called the value function, which is very similar to this, except that you just condition on starting in some state, S1. You don't condition on taking a particular action. You assume that you follow the policy pi, and that expectation is what's called the value function. So as we said, these are optimization problems, so you can denote the optimal state action value function as Q star. Stars in this talk typically mean optimal solution, and what you're trying to do is maximize over the available policies. That can be typically as restricted to some particular class of policies. And as I said before, or as you may already know, in dynamic program, you go through this technique of either value iteration or policy iteration. The idea is you keep iterating and improving across each iterate until you hopefully converge at some result. And there's different types of convergence results and results around finding properties of optimal solutions that you have depending on the particular problem and the structure. It's easier to show in a discrete problem if it's discrete state, discrete time, and discrete action space that you actually arrive at an optimal solution. It's much more difficult to do in a continuous problem because you typically converge to a local optimum, and you won't know that you have. If you were at a global optimum, you wouldn't even know it unless you could exhaustively search the space. So in any event, in policy iteration, there's two steps. There's policy evaluation, which you typically compute the value of this Q function for your current policy pi, and then you improve on that. There's various ways you can improve on it. Here I'm using a delta function. This is assuming a discrete action space. You typically look for the best possible action given that you're in a particular state, and then you bake that into your policy, and then you do the iteration again. When you come to a new state, you try to look for the best action to take in that state, and so on. And there's something called the policy improvement theorem that says that under certain conditions, you converge to the optimal solution. And like I said, it's typically those convergence guarantees are only strong in sort of very simplified or more structured problems. So here, this delta, one thing I should mention, this delta function is really, you can do this for a deterministic policy. When you have a stochastic policy, you need to do something else. Or you don't have to, but you typically will. You'll do something like what's called Gibbs policy improvement, or softmax, or an epsilon greedy policy improvement, because after all, it's a stochastic policy. This delta function only really works, or is only guaranteed to give you the optimum policy in that class if it's deterministic. The reason that we have stochastic policies are because for certain types of problems, the deterministic policy is suboptimal. So one simple example would be the game rock, paper, scissors, for example. For those of you, I think most people know that game. You can show, it's not too hard to show, that a deterministic policy will be suboptimal, but a stochastic policy that uniformly weights those choices, rock, paper, scissors, actually produces a Nash equilibrium. So depending on the problem, it's to our advantage to consider stochastic policies. Okay, so those are sort of classical techniques, as I said, value iteration, policy iteration. However, there are some problems with these techniques. As I said, it's a lot more difficult to implement when you have a continuous action space. And so one approach that people take, and also this relies on the use of value functions, which you typically won't know if you don't know the model structure. You'll have to approximate some way. And a different approach, and the one that's explored in this research, is what's called policy search, direct policy search. And typically what happens there is you parameterize the policy pi in terms of some vector of parameters theta, and you try to successively optimize over that vector of parameters theta to find theta star. And essentially, the optimal policy pi star is determined by that set of optimal parameters theta star. But as I said before, typically you're going to arrive at a local optima. Okay, so gradient descent, as I said before, so pi is a stochastic policy in this setting. Remember, our goal in reinforcement learning is to maximize expected return. We just give that a name, and we just call it j of theta. That's our cost function, or our reward function as a function of theta, which is the parameters for which we want to determine the optimal value. And so this is nothing more than just the integral of this probability density function times the rewards. The density function is essentially telling you what is the likelihood of that trajectory of states and actions under the particular set of parameter values theta. And so as you vary the parameters theta, you're going to produce a different trajectory of paths, right, for states and actions. And the idea is that should produce you higher rewards, and this is the expectation that you want to maximize. So as we said, the goal of direct policy search is to find the optimal theta star. And one way to do it, the naive way to do it, is gradient ascent, right? The first order method, which we see in a lot of classical optimization problems, you follow the first derivative, right? And hope that you end up in a good place. For a very simple problem structure, like a convex problem, or if you're trying to maximize it at concave problem, if you're trying to minimize it at convex problem, well, that will give you the global optimum. But typically, as I said before, we don't even know the model structure, the system behavior, let alone the fact whether it's convex or concave. So we follow the first derivative, and we hope to get to a good place. This epsilon parameter here is a learning parameter. You typically see that in most optimization algorithms. It's a hyperparameter in itself, epsilon, like how much do I follow the first derivative, right? How far do I go along that tangent line? One aside I wanted to make here is there's something called natural gradients, which work under a slightly different metric. These have nicer properties. Instead of just computing the gradient directly in terms of theta, it essentially applies a transformation and computes the gradient under a different metric, which essentially essentially allows you to do a search in the units of probability space. And why that's better is it's smoother, it gives you better convergence guarantees. If you think just simply in terms of linear regression, for example, it's difficult to know if you're doing OLS, like what units you should put your explanatory variables in, right? And such that they are all, quote, as important, right? Or on a relative basis, equally important. If you put certain random explanatory variables in different units, that can skew their importance in the fit. And so this is the same concept applies here. Granted, it's perhaps a more complex setting. But the idea of natural gradients is to balance out the contribution of each parameter in that parameter vector. Okay, so again, this is model free, so we don't know this transition function P of H. So the standard way to approximate the gradient is to do sample average approximation. And so that's what we're doing here. You compute the gradient of J, the estimate anyway, J hat, summing over all samples that you generate from the data, or from the system, really. And so that's what the subscript n means. The subscript t, of course, is time, because we're running this for an episode, typically, times t1 through capital T. The reason we have this log term in here is this, you'll see this a lot in the literature, is it's something called a log trick. And essentially, it avoids us having to differentiate P itself, because, as I said, we don't know P. So by using this log trick, we essentially don't have to differentiate P directly, and we rely on sample averages to tease out what the distribution of P looks like, at least numerically. Yeah.
And if you don't know P, how do you know number?
Say what?
If you don't know P, how do you know data?
You tease it out numerically. So this algorithm has a name. It's called reinforcement learning. And you will see this name referenced in the literature. So for the Gaussian policy model, theta, there's just two parameters, mean and variance. And so you express pi in terms of these two parameters, and you take these gradients. So in this example, P is given this particular structure here, so you can work out analytically what the derivatives are. If you don't know the structure, then you're going to have to tease it out numerically somehow. There's one other concept that I wanted to mention, which is called baseline subtraction. And you'll see this referred to in the literature under different names. One name is called advantage. And the value of baseline subtraction, as you know, in most Monte Carlo pricing algorithms, they're typically high variance. The same is true here. If you just directly compute these gradients, this algorithm typically has high variance, again, because we're doing Monte Carlo sampling, sample average approximation. So standard technique with Monte Carlo type approaches, again, variance reduction, no different here. And so that's what this notion of baseline subtraction is based around. As I said, it's called advantage function, and typically what's used as the baseline estimate is the value function, or an approximation of the value function. And in the literature, this type of approach is referred to as an actor-critic method. So that's something I actually wanted to put on this slide. I just realized in the last day or so that it's not here, but it's an important term to keep in mind. It's the so-called actor-critic method, where the actor is the policy itself, the critic is the value function. And so one way to characterize these types of algorithms are, as we talked about before earlier, just value iteration-based, direct policy search, which is policy-based, and something in between, which is actor-critic method, where you use both the policy and the value function. In this particular case, we're using the value function to reduce the variance.
Question?
Yeah.
I'd like to understand how does the fact that the policy is stochastic play into the algorithm?
Play into the algorithm? Well, you see it right here, right? So this is a Gaussian policy algorithm, right? So what's the probability that I take an action A given I'm in a state S? It's distributed around the mean, right? So you see this mu transpose phi of S? That's essentially the mean, right? So you think of this as a continuous action space now, right? So that's the most likely action, or that's the expected action you would take. But you just have a Gaussian distribution around that one particular action. I mean, of course, you can still run this machinery through with deterministic policies. But the idea here, as I said earlier, is that stochastic policies typically are more powerful, right? At least for these types of problems. Yeah. Right. So that's a problem within itself, right? I mean, as you know, there's many choices of basis functions. Linear is the simple one. You could polynomial basis, some other types of basis. I think one of the speakers yesterday talked about different types of basis. So this particular calculation is just done using a very simple linear basis that may or may not be the best one. Yeah. And by the way, so this is a very dense and compact slide, and like I said, I actually left some things out. You could probably make 5 slides just on gradient ascent method on its own. For those of you that have a background in optimization, as you know, there's a lot to gradient ascent or gradient descent. There's many papers written on this topic. So this is a very dense slide. There's actually a lot going on here, and perhaps in another revision of this deck, I would expand on it a bit more, like I said. So another technique, EM, expectation maximization. You see this a lot in statistics when there's hidden or latent variables. It's a similar concept here. the idea essentially is to construct a lower bound, essentially take advantage of Jensen's inequality, to construct a lower bound and then try to improve that lower bound. So in this context, we have a function f. Log is concave, so minus log is convex. We have a PDF q, and we have a particular function g. And so essentially apply Jensen's equality here on the log. Minus log is convex, so that's why you have to flip the signs on this. And essentially, we're going to exploit this property and try to maximize the lower bound. So in this setting, R of h, like we said, that's the return over the trajectory we want to maximize. Theta tilde is the current parameter value. If you let q be this quotient, essentially that is a density because the denominator is the integral of the numerator. The numerator here essentially is representing what's the probability of that trajectory times its return. And like I said, the numerator is the integral of this. That's what makes it a density. So G is this quotient here. And if you do a little bit of algebra, I'm not going to do it right over the spot, but if you go through this a little bit carefully, you'll see that you can essentially form a lower bound on the right-hand side here. And so you can write log of j of theta is greater than or equal to log of j tilde of theta, which is essentially this right-hand side plus this extra term log j of theta tilde, which is actually the numerator of one of the terms on the left-hand side. So in this, as I said, in this approach, essentially what we want to do is to keep driving up that lower bound. And as I said, this is actually a fairly classical technique. There's nothing revolutionary about this here. It's just used perhaps in a slightly different context. And so you sequentially want to just keep improving and driving up that lower bound. That's the idea of this. Now, if you converge, as again, we don't exactly know what we're converging to. It's most likely a local optimum. But the idea is at least, hopefully you're improving or learning something about the behavior. For simple policies, like we talked about before, the Gaussian policy, you can analytically derive what's the theta hat or what's the argmax in the current state for the current policy. For others, you're going to have to, I think the gentleman asked earlier, you're going to have to come at it through other means, right? So the third technique that I wanted to talk about is called PGPE, or policy prior search. So the idea here is that we talked a little bit before about how these Monte Carlo techniques suffer from high variance, and one way to reduce the variance is this so-called baseline or variance reduction technique, or using the advantage function and using an actor-critic method. Those are some terms you'll see in the literature. Another way to go about it is to think about the problem a little bit differently and say, okay, I think we talked to someone asked before about stochastic policies. Well, this method takes a slightly different tact. It says, well, what if I restrict myself to deterministic policies, but I allow some randomness or uncertainty around the distribution of those deterministic policies, right? So then I'm essentially generating a stochastic policy, but through a different means. And so that's what this PGPE is about. It's kind of a nice idea. And so this essentially pushes the optimization up one level, whereas before I was optimizing directly over the parameters for my stochastic policy. Now I have a deterministic policy, but it's that choice of deterministic policy is driven by my choice of hyperparameter values. So that's what this is about, and I think one of the speakers yesterday talked about his software helps tune these hyperparameters. So one thing that comes to mind is it might be useful for this kind of a problem or this kind of an approach. And so what this diagram is showing you is just the difference between stochastic policies and deterministic policies. But keep in mind, PGPE, while it's deterministic, you don't know which of those paths you're taking. That is random. So that's what introduces the stochasticity into the policy. So here now, because it's deterministic, we write pi in terms of this delta function, because we only take this action A, which again, it's driven by your choice of basis function. Here it's a linear basis. phi, based on some particular, where theta is now drawn from a hyperparameter rho. But the delta function, again, is because it's deterministic. You only take that particular action. And so we can write our j now, again, our cost function, or reward function, rather, in terms of our new parameter, which in this case is the hyperparameter rho. We have an extra integral, right, because now we need to integral over the density of the hyperparameter. But other than that, the machinery really carries through. There's nothing that much different about it. It's very similar to the gradient ascent algorithm we saw a couple slides ago. The only difference here is now we have a vector of hyperparameters, whereas before we had a vector of parameters. Okay, so those are the three policy gradient techniques that are explored in this research. I'm actually going to switch gears a little bit now and talk about evolution strategies. Just remember, the idea of this research is to actually try to compare and contrast these gradient versus gradient-free techniques for this particular type of algorithmic trading problem, kind of see what we learn and what we find. And so I chose two of the leading algorithms in evolution strategies. Just again, evolution strategies are built on these concepts or principles of how we evolved, essentially, natural selection, adaptation, mutation, crossover. It's a rich and deep subject in itself. It goes back quite a few decades. There's many papers published on this. While one can show that, at least in simple problem settings, that you can converge to an answer it's very difficult to understand or prove things about the convergence rate. That's a lot harder to show. There are techniques in Markov chain analysis and function analysis that people use, at least for simpler strategies, to try to show rates of convergence for some of these techniques. But to my knowledge, there has been no research done on rate of convergence, at least for CMA, covariance matrix adaptation. It has been, I think, recently proved to converge, but little is understood about the rate of convergence. So typically what people do in the research is more empirical and just kind of like this project here, just compare and contrast the performance out of sample of these techniques. It would be an interesting line of research to actually see what one can show more theoretically in terms of convergence. Anyway, the first of these two techniques, FEM, fitness expectation maximization, is essentially the technique we just looked at, expectation maximization, classical technique. The twist here, or the nuance here, is to, for those of you that are familiar with economics, to essentially utility weight the reward function. And so if you look at this, that we want to maximize. So you look at the j of theta function here, you've got this u term, this u of f of z. So this u is new. So before we were just essentially computing the fitness or the reward, f of z, but now we're ranking it based on utility. So what this helps you capture is the risk-averse or risk-seeking preference of the investor or whoever is trying to solve this problem. FEM uses a pretty simple piecewise linear ranking. It's not sophisticated in that sense, but nonetheless, as we will see, it still produces some promising results. And so again, P of z here, given the parameter theta, and this simple setting is Gaussian. Okay, it's kind of the same story. We don't necessarily need to go through it again, but again, there's two steps in EM, the E step and the M step. As we said, the E step, you're trying to maximize over that density. It turns out that the maximal density has this form, which is just the density times the utility of the reward scaled by the integral of that. To show this, it's actually not that difficult. It's a Lagrangian problem for those of you that have background in optimization. It's a Lagrangian with the additional constraint that Q integrates to 1. So that's how you show that. In the M step, it may or may not be easy to show. It depends on the particular policy. As we talked about before, if it's a simple Gaussian form, it's easier to show what's the optimal theta hat. If you don't know that, then you're going to have to come at it through some other means. At least for Gaussian policy, it's a fairly straightforward algorithm that you can see below. Essentially, it amounts to just updating the parameters, which in this case are just the mean and the variance, based on how the out-of-sample performance utility ranked, or utility weighted in this case. Sorry, I realized I was one slide back. My bad. Okay, the next algorithm, CMA, I'm not going to cover this in too much depth because this algorithm is really quite complex. I won't say that I thoroughly understand this algorithm. It takes quite a bit of depth to really understand it. I will say that these two algorithms are competitors. FEM is a little bit more intuitive to understand because, again, it's just the classical EM algorithm, utility weighted. CMA is a more sophisticated algorithm. For those of you that have a background in optimization, it's similar to a second-order method, like a quasi-Newton method, where you invoke the Hessian, or you need to compute the Hessian, essentially, to look at to improve your search direction or to improve your parameter update. So in some sense, it's like that. There's a lot of ways you can think of CMA. But in simple terms, I will say it was designed, again, to solve very difficult problems that are very jagged, which you can't really differentiate the solution space, hence it's gradient-free. But there are ways you can think of it analogous to, or I will say that the parameter updates that happen in this method to the mean and the variance, as we'll see on the next slide, can be thought of or posed in terms of natural gradient updates. So even though it's gradient-free, you can kind of think of the parameter updates as happening in a natural gradient way. So there's two sets of parameters. Again, it's a Gaussian method. We have a mean vector, and we have a covariance matrix that we need to update. There's a couple of interesting features to this approach, CMA. One is step size control. And the idea there, although I don't have a picture, is to essentially, if your incremental updates that are successful, you want to continue in those directions and essentially improve the search step or increase the search step in that direction. And incremental updates that are less favorable, we tend to scale back on the step size. So that's the idea of step size control. The mean vector M, the new mean vector M, is essentially a weighted average of the most successful mu points from the current generation. And we go through an exponential smoothing so that we keep track of the previous updates. But it's evolutionary in that sense, in that you essentially keep the best performers from the current generation. And the covariance matrix update has similar kind of concepts in that we use what's called a rank 1 update and a rank mu update. The rank 1 update essentially keeps track or shapes the covariance matrix around what's called the evolution path, which is essentially the sequence of successful incremental updates or search steps. There's also a rank mu update, which essentially shapes the covariance matrix around the top mu most successful candidates in terms of fitness or performance from the current generation. And so the total covariance update is a sort of a composition of both of these effects, a rank 1 and a rank mu update. Again, the idea being we move towards these optimal parameters M star and C star, which denote the theta vector. And so this is a kind of the full algorithm. There's a couple of research papers which I mentioned on the reference list, which you can explore this algorithm in detail. I will say that I'm still learning about this algorithm. It's quite complex, but it's quite interesting. It performs pretty well, how shall I say, in classical problems, static optimization problems, which have very rugged features, ill condition, things like that. So it is actually one of the pretty powerful algorithm. All right, so the problem that I looked at, it's an automated or a stylized algorithmic trading problem. As I said before, this occurs in the academic literature. That's kind of why I chose it. There was a paper written, which I followed by a guy named Nechi, who explored primarily just these policy gradient algorithms with regard to this particular automated trading problem. And so my paper is really an extension of his to compare and contrast the evolution strategy methods. So that's why I actually wanted to keep the setup similar, if you will, because I kind of wanted to see how the evolution strategies compare. Anyway, in this problem, there's a synthetic risky asset. It follows a random walk. It has an autoregressive trend, beta t. And as I said, that's what allows you to sort of game the system or increase performance or returns beyond what you might normally do in the market. And so this follows a pretty simple series. As you can see here, this equation for zt, autoregressive error 1. And beta t itself is autoregressive with this coefficient alpha. And the final synthetic price series is this capital Z of t, and this is just a normalization, essentially, with over the maximum and minimum values in the denominator. And so the problem that we're solving is essentially where we have a portfolio, we have a risky asset, we have a riskless asset, which can be a stock or a bond. Well, it wouldn't be a stock, but it would be a bond, typically. In this particular problem, I use a bond. And the idea is to essentially, you take in the current market state and you need to make an investment decision, right? You know, how do I allocate my portfolio weights? W1, W2 in this case, there's just two assets across my assets, which are just the one risky asset, the stock, and the riskless asset, the bond. You could easily generalize this to multiple assets and assets. And the trading actions that we're allowed to take are between long and short. So continuous value between +1 and -1. You are allowed to go short. I don't allow leverage in this problem. You could consider leverage. I don't consider transaction costs. You could do that too, and that would actually affect the answer. And so what we typically use to model the actual investment decision is a neural network. So what we do is we take those parameters, however we get them from the evolution strategies, and we essentially use those to specify a neural network. So that neural network is going to decide whether, for that set of parameter values in that market state, should I go long or short or how much. Okay, so this slide really talks a little bit about the experimental setup. Some of these algorithms, like PGPE, are trained. Well, one thing I will say is that it's a decision whether or not, when you go out of sample, do you still want to allow learning. For this particular project, I did allow learning out of sample, primarily because the original paper, Necci's paper, did also, and so I just wanted to be consistent. And that's what leads to some really high returns. You don't need to do that, and in fact, if you don't do that, of course, the returns will come down. So when I show the returns on the next few slides, they're going to be quite high. Again, that's because you're learning continuously. And remember, this is a stylized problem. So there's known market information that we can exploit in terms of those autoregressive trains. I wouldn't, of course, these returns are going to come down quite a bit in a real market situation, although it would be interesting to test. Anyway, so a little bit of terminology here. We refer to an epoch as a full view of the training set. I partition the full training set into episodes. This is arbitrary how you partition it. I've experimented with different partitions, but in this case, it's 10 steps, daily market moves. I define as an episode. It's a very short trading period. You could make it monthly, quarterly, annual if you like. That's fine. Because it's a short step, only 10 steps, we have 400 episodes available. In the case of PGP, because it's a hyperparameter, for each episode, you're drawing a parameter theta now, remember, as well as a reward sequence H over those 10 steps in this case. For FEM and CMA, these evolution strategies, we evolve a population of 10 candidate solutions. And so the candidate is subscripted by K, the episode is N. And again, these are parameters are fed into this deterministic controller, or and in this case, a neural network, which is used to actually make those decisions. A little bit of information about the out-of-sample test set, 200 episodes, again, 10 steps, 2,000 total daily market moves. Right, and so, as I said before, learning continues out of sample. That's a choice. You could run it either way. And yeah, one other aside, we could, for this exercise, we're using a deterministic controller. We could do something more sophisticated. We could use a Boltzmann policy so that it's not a deterministic controller, but in fact a stochastic controller. But for this exercise, in the interest of being consistent, I used deterministic controller. And so here are the first results for FEM. You can see it performs extremely well. If only we could generate return. I knew how to generate returns, so that's great. But yeah, was there a question? Yeah. Yeah. Yes. It's continuous. I'm sorry, I can't hear. How do you what? How do you hedge risk? I'm sorry?
How do you hedge the risk? Because it's a discrete time, right?
Sure. I mean, the real market, I mean, you would just produce a hedge portfolio to reduce the exposure. I'm not sure I quite understand the question. Do you mean how would you continuously hedge risk? Is that, huh?
Yep.
Well, you would, in this setting you wouldn't though, right? You would only hedge on a discrete basis, right? You'd put your hedges on at the same day you put your position on, and then for the next realization of the market, the portfolio is going to move and the hedge is going to move. Yeah. Okay, so PGPE, again, produced really quite good returns, set 60, 70%. Not quite as strong as FEM, but nonetheless very respectable. And so this was the surprise for me, actually, was that the most sophisticated algorithm really didn't do that well. And this was a real head scratcher for me, and honestly, it has been for quite some time. It's still unresolved. And so this, this was surprising to me. I will say that I tried conducting additional experiments to see if I could dig into exactly why it doesn't perform as well, and it's still unclear to me as to why this is the case. So this is something I would like to explore in further work, is exactly why it doesn't perform as well. So one additional experiment I ran, as we talked about before, this is a stylized market move. It follows autoregressive trends. You can exploit that. And in fact, all of the algorithms do, as we just saw. So what I decided to do was to introduce some more uncertainty into the market. And so I added some Poisson jumps, essentially, to the stock price, the synthetic price process, to see if that would help CMA on a relative basis in terms of its performance, and it actually did not. So it's still lagging. Again, as I said, it's a bit of a mystery to me as to why. And so my hope is I'll be able to dig into this and understand this a little bit better, perhaps as my understanding of this algorithm improves, or as I do dig a little bit deeper into this problem. I have tested it on more simple classical problems, like I said, static optimization problems. It does what it says it will do, right? It works as built. It converges quickly, and it does make sensible moves. But when I jump to this much more complex problem, somehow it's lagging. And I've yet to figure out or thoroughly understand exactly why that is. So that's kind of all I wanted to talk about today. Hopefully it was helpful. Just as a brief recap, we talked very briefly on reinforcement learning. There are some great references out there on reinforcement learning. That's a deep and rich subject within itself. On the next slide, I'll list some references for all of the topics and themes we talked about today. And if you are interested in them, I encourage you to pursue some of those academic references, which will give you a deeper dive and perhaps more insight into what I talked about or what we've covered today. We talked about some policy gradient algorithms. Again, kind of the first one, the naive one, gradient ascent. There's many variations of that. Another classical technique, used in statistics, expectation maximization. And we talked about a little bit different of a technique using a prior distribution, the policy prior search, PGPE. We talked about 2 evolution strategies, 2 of the cutting edge ones, FEM, which is a bit more intuitive to understand. Again, it's just a variation on expectation maximization, which is a classical algorithm. And we went through a little bit more cutting edge algorithm, CMA, covariance matrix adaptation. But again, it can be linked to classical methods, as we said before, a quasi-Newton second order method that uses the Hessian. And we went through a very stylized problem in algorithmic trading to compare and contrast those methods. You're welcome to try this out in a real market situation or real market dynamics and see how they perform. And we talked a little bit about the results. I'll just quickly show you the references. So some of these references I think are really good. For those of you that know reinforcement learning, Richard Sutton's book, this is the Bible, essentially, of reinforcement learning. Sutton and Bartow are, in some sense, the founding fathers of reinforcement learning. There's another great book on statistical reinforcement learning by Sugiyama, which I took some of these slides from and some of this notation from. It's another great reference. The particular method, FEM, was developed by Dan Weerstra and his team. They also wrote the PyBrain package, by the way, which is what I use to implement these methods. CMA evolution strategies was developed by Nicholas Hansen. Maybe he has some ideas on how to improve the method. The original paper on reinforcement learning for automated trading, I want to give credit to Mr. Netchi. Again, it's his work that I've essentially extended. His work was primarily based on these policy gradient or policy search techniques. I've added the evolution strategy techniques to it. And it's still a working paper. It's not published, but this last reference is essentially the paper version or the academic version of this. And that's all I have. Go ahead. Yep.
In your trading strategy, what was your final position? I mean, was it dynamically hedged constantly, or you end up with a position in terms of the security and the risk assets?
I mean, I didn't read back out the output, to be honest with you. I did for certain cases, but it's what you would think, right? It's going to vary your long and short positions as the market evolves. When it takes a short, hopefully the market drops, right, in terms of.
But what I was trying is at the end, what was the portfolio that you had at the end? I mean, was it like you had a long exposure, or?
It's going to vary based on the particular market scenario, right? I mean,
because I think one of the P&Ls could vary because of what you end up with the risk that you accumulate.
Right. I mean, you could reverse engineer it essentially from, I didn't store it, but essentially whatever the last position is at that market return is what it is, but I didn't save it, yeah.
Because I think some of the processes that are going here is the dynamical replication that is optimizing properly. So it will be interesting to find out the balances as you move as you reinforce learn the process.
Absolutely. I mean, the gentleman behind you, I mean, an interesting problem would be hedging replication strategy as well. I mean, this is primarily focused on returns, but as I said, you could look at what's an optimal hedging strategy. You could embed risk into the actual functional, like we said before, CVAR or some other kind of metrics. This is really keeping it simple, just focusing on cumulative return. But if you were really managing a portfolio, you would definitely want some risk metrics embedded into the function.
Because a lot of the strategies that they used on this is to actually to figure out the reinforced learning will actually figure out the optimal dynamical hedging strategy. And then you actually get a return out of that too. So that's the interesting part.
Yep. There are some interesting papers written around by Guy Halperin from NYU along those lines, essentially using reinforcement learning to essentially learn what is an optimal hedging strategy. Yeah.
I don't need a microphone. I talk pretty loud. Oh, I should? Okay. Yeah, so you said you wanted to implement this probably next year. What are the barriers for the change managers or you to getting this implemented at the corporate level?
Yeah, that's a great question. Pretty high, right, is the answer. So when I say implement, that would be multi-phases. The first phase is just some kind of benchmarking or informative tool or technique versus what we do now. But I think a lady from CSB, Credit Suisse, yesterday talked about the many challenges you have in pushing these machine learning algorithms into production. And you're going to have to satisfy model validation. You're going to have to satisfy regulators, audit. There's a lot of challenges to it. In my mind, it's, you do it in stages. You learn as you go. It's going to take some time before you really do something like this in production. Now, I mean, we're a big bank, U.S. bank. We're $500 billion. We have a lot of regulatory oversight, right? So for us, we have a lot more scrutiny. If you're a smaller player in the industry, if you're a niche fund, right, or a hedge fund, or you can fly under the radar more or less regulated, you have a much lower barrier to entry than what we do. Yeah. Yeah.
Oh, thank you. Just another comment. I think you may want to compare the multi-period Marquez optimization. So
Compare the what?
Multi-period Marquez optimizations as a benchmark, because
Sure.
You just maximize return and put some constraint there.
Yeah, this is
Multi-period, right?
multi-period
But
return.
this is done by reinforcement learning.
Yes.
Right? I'm saying that if you run the multi-period Marquez optimization, you may have some similar results or worse results, but at least you have a
Sure. You
reasonable
mean like a
benchmark.
classical benchmark is what you're saying.
Right.
Sure. Markowitz.
Also,
yeah.
for the condition, I guess you have a
Self-financing strategy.
Yeah. Okay.
Yes. You could try leverage, but yeah. I mean, yeah, it's just, it's synthetic. It doesn't really matter, right?
Okay, but like what is the Sharpe ratio of this strategy? Like your
You,
public.
you could compute it. I didn't compute those metrics.
Okay, but like a bond, simple bond would probably do better than this, or would it not? Like
No,
over a
so the
period of-
risk-free rate in this example is 0.
Okay.
Yeah, so the baseline, I show you the blue line. I mean, you could, let me take a step back. What I call buy and hold,
Yeah.
it's arbitrary what you use as your baseline. So I just chose interest rates of 0 as the baseline. So the buy and hold bond portfolio has 0 return in this case.
Okay.
Yeah. Thank you.